Welcome to PhillipCapital's Weekly Market Watch. We have seen many investors staying away from the market when the global economy went into a tailspin last year. So, are we expecting an economic rebound in 2010? Let us find out from Mr. Liang Shiping, investment analyst from Phillip Securities. Shiping, what is your overall sentiments on global economy in 2010?
We think that uncertainty is the watchword in 2010. At this moment, we do not really have a clear market direction. We feel that this year may be a very difficult year in fundamental sense because so many different elements are at play. We have the US and Eurozone unemployment situation, and what are the ECB and Fed going to do if unemployment rate stays high or goes higher than 10%? On the other hand, we just saw tightening in China on its equity and property prices. And there are also concerns on the China growth story. Also, we have questions about are the carry trade players going to continue the equity rally with the cheap money available? So, we think that investors have to really forget about the trend in 2009 and start 2010 with an open mind with so many uncertainties around the world.
You mentioned about the growth story in China. Would China be the place to invest in for 2010?
We think that the China market is going to get a little bit more volatile in 2010 with short selling and margin financing on index contracts made available. Therefore, investors who do not have the appetite for high risk can perhaps look at other countries or other markets to play the China growth strategy. Right now, what has happened so far is that the growth story in China has been putting pressure on the US dollar with the rise in commodity currencies such as the Canadian dollar and Aussie dollar. For investors who believe in the growth story of China, one of the ways to play this strategy without being directly involved in the volatile China market is to look at exporting countries like Australia. We understand that the coal and iron ore are Australia's two largest export items to China. And the strong Chinese demand for coal and iron ore is leading to higher export revenues for Australia in both volume terms and value terms, as these commodity prices are pushed higher.
So why do you think China goes to Australia for their commodities?
As an economy itself, Australia has very good and sound fundamentals. They are in a very strong banking and fiscal position, and unemployment rate is just half of its Western counterparts. We think that the unemployment rate actually came down to 5.5% on a quarter-on-quarter basis. At the same time, we don't really see any housing market correction in Australia, and it is one of the very few countries to avoid a recession back last year. Most importantly, the Central Bank of Australia, the RBA, has increased the interest rate on 3 consecutive occasions, which no other central banks can match that at the moment. With a higher domestic interest rate, inflation will be kept low, and carry trade players, like I mentioned before, will be looking to park their money over in Australia given the higher yield. So for investors who believe in the recovery of global trade and the China growth story, they should really pay attention to Australia. Investors can have direct exposure to Australia simply by buying into unit trusts investing in Australian equities. Performance-wise, the one-year return of most Australian funds has been close to 60%.
Thank you, Shiping. That's all we have for you today. Tune in next week for more market updates.